Good day, FAC4862/FAC4864 student. Today we will be dealing with how to account for the acquisition-related costs and other transactions costs, both at the financial statements that are separate and also at the group financial statements. We have noted that students often get confused with the treatment as it differs with each type of investment and financial instrument. But before we deal with the accounting treatment, let us define what are the transactions costs. These are the costs that are directly attributable to the acquisition or issue of either an equity instrument or the financial instrument. These costs must be incremental in nature. In other words, they would have been avoided if the entity did not acquire or issue the relevant instrument. The examples of this include the cost of registration, the legal fees, accounting fees, and many others. How do we then account for these instruments? In a case of a business combination, in other words, when one acquires a subsidiary, the transactions costs do not form part of the consideration transferred as they are expensed when they are incurred. There is, however, an exception, and that is the transactions cost incurred in the issue of a debt or equity instrument are not expensed, but they are deducted against the relevant equity instrument or the debt instrument. We will look at the journal entries at the end of this presentation to illustrate this. Now, in a case of an equity method, in other words, when one acquires either an associate or a joint venture, the transactions costs do form part of the consideration transferred, as they are not expensed when incurred. They are actually capitalized to the carrying amount of the investment in associate or a joint venture. Now, in the case of transactions from financial assets and financial liabilities, it depends on the classification. For the financial assets and liabilities that are measured at fair value through profit or loss, the transactions costs are accounted for as an expense in the profit or loss and other comprehensive income, and they are not capitalized. For those financial assets that are measured at fair value through OCI and amortized cost, and financial liabilities that are measured at amortized cost, the transactions costs are capitalized to the carrying amount of the financial asset and against the carrying amount of the financial liability. Now, in the case of the equity instrument, the transactions costs are accounted for as a deduction against the proceeds from the issued equity instrument. Now, let us look at the summary of the above accounting treatment with some illustrative journal entries. For financial assets and liabilities measured at fair value through profit or loss, the journal entries would be to debit the expense item in the profit or loss and then credit the bank, assuming the transaction costs were a cash transaction. For financial assets measured at fair value through OCI and at amortized cost, the journal entries would be to debit the financial asset with the amount of the transaction cost as we are capitalizing it to the carrying amount, and then credit the bank, assuming the transactions cost were a cash transaction. Now, for financial liabilities measured at amortized cost, the journal entries would be to debit the financial liability with the amount of the transactions cost as we are capitalizing it against the carrying amount, and then credit the bank, assuming the transaction costs were a cash transaction. Lastly, for equity instruments, the journal entries would be to debit the equity instrument with the amount of the transaction cost as we are capitalizing it against the proceeds from the issue of the equity instrument, and then crediting the bank, assuming the transactions costs were a cash transaction. Thank you. See you on our next video.